$65 billion. That's how much money Bernie Madoff told his clients they had. None of it existed. Not a single dollar of it was real. For nearly 2 decades, Bernie Madoff ran the biggest financial lie in human history, and almost nobody suspected a thing. Queens, New York, 1938. Bernard Lawrence Madoff is born to a working-class family. His father, Ralph, sells sporting goods. His mother, Sylvia, briefly runs a broker-dealer, which gets shut down by the SEC for failing to file financial reports. Make a note of that. The SEC and the Madoff family have a complicated history from the very beginning. Bernie is smart, ambitious. He works through college, lifeguarding, installing sprinkler systems, saving every dollar. In 1960, at just 22 years old, he takes $5,000 in savings and starts a company, Bernard L. Madoff Investment Securities, LLC. He starts as a penny stock trader, buying and selling cheap, low-price stocks outside the major exchanges. Small time, nothing glamorous. But he has one major advantage: his father-in-law. Saul Alpern was a respected accountant with a wide circle of wealthy clients. He started referring those clients to Bernie, and Bernie delivered, or appeared to. By the 1970s and 1980s, Madoff's firm had become genuinely successful. Not just on the investment side, his legitimate brokerage operation was a real Wall Street powerhouse. He helped pioneer electronic trading. His firm was responsible for roughly 5% of all trading activity on the New York Stock Exchange by 1989. He served as chairman of NASDAQ 3 times. He was respected, admired, sought after. People begged to invest with him. That exclusivity was not accidental. Here's something most people don't know about the Madoff operation. It had 2 completely separate businesses, running simultaneously, in the same building. The legitimate side, floors 18 and 19 of the Lipstick Building in Midtown Manhattan, was a real, functioning, respected brokerage firm. Hundreds of employees, real trades, real technology, genuinely successful. The fraudulent side, floor 17, was where the Ponzi scheme lived. A small, separate team, mostly loyal employees who had been with Madoff for decades, run by a woman named Annette Bongiorno and an office manager named Frank DePascali. Their job was simple and terrifying. Every month they fabricated account statements for thousands of clients. Not real trades, not real returns. They looked at old copies of the Wall Street Journal, picked stocks that had already done well in the past month, and backdated fake trades to show that Madoff had bought them at the low and sold them at the high. The strategy Madoff claimed to use was called a split-strike conversion, a real, legitimate investment strategy, just complex enough that most clients couldn't fully understand it, just plausible enough that no one pressed too hard. What actually happened to the money? Clients handed it over. Madoff deposited it directly into a single Chase Manhattan bank account. Business account number 703. That was it. When clients wanted withdrawals, he paid them from the same account, using money from newer investors. Classic Ponzi. Painfully simple. The genius wasn't the fraud itself. It was the reputation that made it invisible. Who invested with Madoff? Everyone. Major European banks. Banco Santander of Spain, $3.1 billion exposed. BNP Paribas, $431 million. HSBC, $1 billion. Hedge funds that were themselves managing money for thousands of clients, so-called feeder funds, poured billions into Madoff's account. Fairfield Greenwich Group alone had $7.5 billion with him. Charities, foundations, hospitals. The Elie Wiesel Foundation for Humanity, which the Holocaust survivor had spent decades building, lost $15.2 million. Everything it had. Retirees, people who had spent their entire working lives saving, who handed everything to Madoff because someone they trusted told them to, who lost houses, whose lives were destroyed, and the celebrities. Steven Spielberg's charitable foundation, Kevin Bacon, Kylie Minogue, Mort Zuckerman, people who thought they were the lucky ones, the ones who had managed to get into the most exclusive investment fund in America. The exclusivity was the trap. People didn't just invest with Madoff. They recruited for him. They brought their friends, their family, their communities. Because being in Madoff's fund felt like belonging to something elite. Here's the part of the Madoff story that should make you genuinely angry. He was caught, years before he was arrested, by one man, who told the SEC everything, repeatedly. Harry Markopoulos was a financial analyst and portfolio manager. In 1999, a colleague asked him to reverse engineer Madoff's strategy to figure out how he was generating such consistent returns. Markopoulos looked at the numbers for 4 hours. Then he told his colleague, "This is a Ponzi scheme. The returns were mathematically impossible." Madoff claimed to be up, even when the entire market was down. His numbers showed a consistency that simply does not exist in real financial markets. Markopoulos compared it to a baseball player batting .966 for the season, while everyone else was batting .300, and no one was suspecting a cheat. In May 2000, Markopoulos filed his first complaint with the SEC's Boston office. He was ignored. In March 2001, he filed again. Ignored. In October 2005, he filed a 17-page document titled, "The World's Largest Hedge Fund is a Fraud," outlining 29 specific red flags pointing to a Ponzi scheme. The SEC opened 2 investigations and 3 examinations of Madoff's firm between 1992 and 2008. They found nothing, because they never asked the right questions. Madoff himself later said he could have been caught in 2003, but that investigators had acted like bumbling detectives who never asked to see his actual stock records. He said if they had just checked with the depository trust company, they would have seen immediately that the trades he claimed to make didn't exist. The SEC did have one close call. In 1992, 2 accountants who were essentially running a sub-Ponzi scheme feeding into Madoff, named Avellino and Bienes, were caught by the SEC. When investigators realized all of their clients' money was with Madoff, they went to check his records. The discrepancies were massive. The statements Avellino and Bienes had given their clients didn't match what Madoff had on file. This was the moment. The scheme should have ended here. The SEC looked at the paperwork, accepted Madoff's explanations, closed the investigation. And there's one more detail that makes this worse. The SEC investigator who looked into Madoff in 2003, his name was Eric Swanson. In 2006, 1 year after Madoff's most detailed fraud warning was filed, Swanson left the SEC and married Madoff's niece, Shauna Madoff. Swanson denied participating in any inquiry while in a relationship with Shauna Madoff. But the optics were not great. For decades, Madoff's scheme survived on one simple condition: more money coming in than going out. As long as new investors kept joining, he could pay the ones who wanted to leave. The lie could continue. Then 2008 happened. The global financial crisis triggered the biggest investor panic in decades. Everyone wanted their money back. At the same time, Madoff needed $7 billion to cover withdrawals. He had almost nothing. He made desperate calls, tried to secure emergency funds from associates, failed. On December 9, 2008, Bernie Madoff called his sons Mark and Andrew into his apartment. He told them he had recently made profits and wanted to pay out $173 million in early bonuses. His sons, both senior employees at the firm, were immediately suspicious. How could he pay bonuses when they knew he was struggling to cover withdrawals? They pushed him. They demanded an explanation, and Madoff told them the truth. Everything, the returns, the statements, the billions, was one big lie, a giant Ponzi scheme. He had nothing left. It was over. The next morning, Mark and Andrew Madoff went to federal authorities, their own father. They turned in their own father. On December 11, 2008, FBI agents arrived at Madoff's penthouse apartment. He didn't resist. He didn't run. He simply said, "There is no innocent explanation." On March 12, 2009, Bernie Madoff pleaded guilty to 11 federal counts: securities fraud, wire fraud, money laundering, perjury, theft. At his sentencing, victims were allowed to speak. Many did. They described losing their life savings, their retirement funds, their homes, their ability to pay for medical care. Some described watching elderly parents lose everything. Some had lost friends, investors who had taken their own lives after the fraud was revealed. On June 29, 2009, Judge Denny Chin sentenced Madoff to 150 years in prison, the maximum allowed. The judge noted that he had received no letters of support from anyone, not a single character reference on Madoff's behalf. $170 billion in restitution was ordered, a number essentially impossible to pay, since the actual money simply didn't exist. The fraud involved approximately $64.8 billion in fictitious account balances. The real losses, actual money that real people had deposited and never got back, were approximately $18 billion. The rest was numbers that had never existed anywhere except on fabricated statements. Madoff's wife, Ruth, agreed to surrender almost all of her assets, keeping only $2.5 million. His brother, Peter, who had been chief compliance officer, received 10 years in prison. His son, Mark, who had turned him in, died by suicide on December 11, 2010. Exactly 2 years after his father's arrest. His other son, Andrew, died of cancer in 2014. Bernie Madoff died in federal prison on April 14, 2021, at age 82. He never expressed genuine remorse in public. He reportedly told people in prison that the banks and hedge funds that fed money into his scheme had to know what was happening, that they were willfully blind because the returns were too good to question. One of the most remarkable parts of the aftermath is how much money was actually recovered. A court-appointed trustee named Irving Picard spent years tracking down assets, clawing back money from investors who had withdrawn more than they put in, pursuing banks and feeder funds, filing thousands of lawsuits. As of 2024, Picard's office has recovered and distributed over $14 billion to victims. Roughly half of all legitimate Madoff victims have been made whole or close to it. The other half, particularly those who lost money in the later years of the scheme, received far less. And of course, the $35 billion that Markopoulos estimated never really existed, the fictional profits Madoff reported, that money was never real. Nobody gets that back. So what do we actually learn from Bernie Madoff? First, the biggest frauds hide inside the biggest reputations. Nobody suspected Madoff because he was too famous, too respected, too establishment to be a criminal. That reputation was the scheme's greatest protection. The more trusted you are, the easier it is to lie. Second, the SEC failed catastrophically. Not once, not twice, 6 times over 16 years, they received warnings about Madoff. They investigated, they found nothing, because they weren't looking in the right places. And in some cases, because of conflicts of interest so embarrassing, they should never have been allowed to exist. Third, Ponzi schemes don't just hurt the greedy. Yes, some Madoff investors were chasing returns that were obviously too good to be true, but many were ordinary people, retirees, charities, community foundations, who trusted someone they'd been told to trust. The victims of this scheme were not all sophisticated Wall Street players. Many were just people. Fourth, it ended not because of regulators, not because of auditors, not because of the SEC. It ended because of a financial crisis that made too many people ask for their money at the same time, and because Bernie Madoff's own sons turned him in. His name was Bernie Madoff. He stole $65 billion. He fooled the world for 17 years, and in the end, it was his own family that brought him down. The biggest lie in financial history wasn't brought down by the smartest investigators or the most sophisticated regulators. It was brought down by 2 sons who couldn't look the other way.